Welcome to Auto News Talk. I'm so glad you're joining us because we're looking at something that, well, it's honestly a bit of a mystery right now.
Yeah, it really is. It's a total contradiction.
Right. Because, on paper, the auto industry looks incredibly resilient. The lights are on, factories are humming along, showrooms are busy.
Oh, absolutely. The top line numbers look fantastic.
But if you step off the spreadsheet and look at the actual showroom floor, there is this massive hidden struggle happening right across the finance desk. And it all revolves around one thing, affordability.
Right. It's this affordability illusion. It's like the train we're walking through is totally solid until you look really closely at the cracks.
Exactly. So we're going to explore how consumer debt, targeted government policy, and this hyper-advanced dealership marketing are all just colliding. And it's fundamentally reshaping how cars are bought and sold.
Which is huge because it changes the game for everyone involved.
So let's map this out, starting with the macro view, because those top-line sales numbers, they're completely hiding a bifurcating market.
Yeah, bifurcating is the perfect word for it. It's splitting right down the middle.
One analysis from the National Automobile Dealers Association paints this really stark picture of that divide. Like the top-tier buyers are completely carrying the weight.
The NAD analysis is honestly eye-opening because they point out that, sure, the top-line demand looks strong, but it's increasingly supported strictly by higher-income households.
Right, the people who can actually afford to write the check.
Exactly. So the middle and lower-income buyers, they are just getting entirely squeezed out of the new car market.
And what's wild is that the squeeze isn't just the sticker price of the car. The NADA piece makes it clear that it's the weight of everyday essentials.
Oh, yeah. It's everything else.
Right. Like these buyers are paying so much more for insurance premiums, for housing, for childcare. So by the time they look at their monthly budget, there's just, no disposable income left in a vehicle payment.
The math just doesn't work for them anymore. But the NADA report notes a really interesting bright spot in all of this, specifically with electric vehicles.
Oh, right. The off-lease stuff.
Yeah, exactly. While new EVs are struggling to find mainstream buyers, used EVs, especially those coming off their first lease, are suddenly this affordability haven.
Because they've already taken that massive depreciation hit.
Right. They offer a much lower entry price for consumers who are just totally priced out of new cars.
That makes sense. If you can't afford a new car, a 3-year-old EV looks like a super pragmatic financial move.
Totally.
But, the NEA analysis still forecasts 16 million light vehicle sales for the year. That's a huge number. That's real momentum.
It is massive. And for dealerships, the implication is that they have to completely change how they stock their lots.
Because of that split consumer base.
Right. They need the premium high-margin cars for the wealthy buyers driving the market, but they also desperately need those affordable, depreciated used EVs just to have anything to sell to the average person walking in.
But, okay, what this analysis doesn't really answer is whether that 16 million sales pace can actually hold long-term.
Exactly, especially as credit conditions keep shifting.
Right. Which brings us to the actual financial trap.
Yeah.
If people are so tapped out by housing and insurance, how are they buying cars at all?
Well, they're doing it with debt. Massive amounts of debt.
Yeah. Another report from Cox Automotive zooms in on the exact mechanic causing this, and it is honestly terrifying.
It really is. The Cox report focuses on the explosion of negative equity.
Being upside down on your loan.
Exactly. Consumers are owing way more on their auto loans than the cars are actually worth, and it stems from the pandemic shortages.
When people were paying crazy markups over MSRP.
Right. High prices, high interest rates. So to make the monthly payment even somewhat affordable, buyers stretch their loans out to 72, sometimes 84 months.
Which is just insane. So imagine this scenario. You walk into a dealership to trade in that SUV you bought a few years ago.
Okay.
You think you've got a decent down payment.
Yeah.
But the dealer says, your car is worth $22,000, but your loan payoff is $30,000. Yeah. You literally owe the dealer $8,000 just to hand over the keys. It's like trying to run a marathon while dragging a parachute.
That is the perfect analogy.
Right. And every time you buy a new car, you're carrying the financial weight of the old one in that parachute.
And the Cox report shows how much friction this creates for the dealer. The buyer finds a car they love, but when finance rolls in that $8,000 of negative equity, the monthly payment skyrockets.
The deal just dies right there.
Often, yes. And the implication here is severe lender risk. This debt cycle follows consumers from car to car. If the economy takes a hit, those massive underwater loans are incredibly vulnerable.
Well, doesn't Cox suggest some ways dealers can handle this? Like steering them to cheaper cars?
They do. They suggest exploring lower-priced cars or shifting them into leases.
But wait, that doesn't actually fix the problem, does it?
That's the huge limitation of their suggested response. It doesn't eliminate the negative equity at all.
It just kicks the can down the road.
Exactly. Leasing just masks the debt temporarily by artificially lowering the monthly payment. But when the lease is up, the consumer walks away with zero equity. The financial damage is still there.
Wow. Okay, so if consumers are drowning in debt and dealers are basically just doing financial gymnastics to make the math work, who fixes this?
That's where the government steps in.
Right. We can see how policymakers are reacting to this exact affordability crisis in a report about California. They're trying to force affordability into the market.
Yeah, California just relaunched a massive $270 million state EV rebate program.
Which is a huge chunk of money.
It is. And the source makes a point to explicitly frame the motivation behind this. They state it's a direct response by Governor Gavin Newsom to the incoming Trump administration ending the federal EV tax credit.
Got it. So just to be clear for the listener, we're not taking a political side here on Auto News Talk. We're just reporting what the source explicitly states as the policy's catalyst.
Yeah, right. Purely the stated motivation for why the state is stepping in. But the mechanics of the policy are what's really interesting here.
Because it's not just free money for everybody.
Exactly. They are using highly specific caps. They're offering a $3,500 rebate for first-time buyers of new EVs, but the car's price is strictly capped at $50,000.
Okay, so no subsidizing luxury vehicles.
Right. And for used EVs, it's a $1,750 rebate capped at a $25,000 purchase price.
Again, very targeted.
The implication is clear. State-level interventions are patching the federal gaps, but they're using strict caps to force affordable adoption. They want to expand the buyer pool, not just give a tax break to a wealthy person buying their third Tesla.
But, I mean, I have to push back on this a little.
Sure.
If consumers are drowning in that negative equity parachute we just talked about, if they're $8,000 underwater, is a $3,500 rebate really enough to save a deal?
That's the big question.
It feels like just a drop in the bucket, like throwing a life vest to a guy tied to an anchor.
It's a very fair point. The math is incredibly stubborn. And there's another major open question with this California report.
What's that?
The effectiveness is totally up in the air because the California Air Resources Board won't even disclose which automakers are participating in the program until a later date.
Oh, wow.
Yeah, if the brands making the most affordable EVs don't join, the program's impact could be severely limited.
So if you're a dealership, you are looking at a market where buyers are broke, negative equity is rampant, and government incentives are heavily restricted.
It's a tough spot to be in.
You really can't afford to just run a broad, sloppy marketing campaign anymore. And a piece from Launch Labs shifts our focus to the showroom side of this.
Right, because dealerships have to completely overhaul their data strategies to survive.
They argue that dealers put way too much faith in massive, but basically useless customer databases.
Which is so true. Data naturally degrades. Think about it. People move, they get new phone numbers, they have kids, and suddenly need a minivan instead of a coupe.
Exactly.
If your CRM is just a static snapshot from 5 years ago, you're flying blind.
So the fix Launch Labs suggests is data enrichment. It's about updating those records with current lifestyle milestones.
Yes, you need to know exactly where they are in their ownership journey.
And the detail that really stood out to me was using this enriched data to find vehicles approaching a highly specific replacement window.
That is the key right there.
Based on the car's age or mileage, the dealer can trigger this hyper-targeted trade-in outreach. So it's very much quality over quantity.
Absolutely.
Having 10,000 emails is totally useless if half those people already bought it.
Right. The implication is that enriched data aligns your whole dealership. It turns a messy database into a unified attack plan for sales, service, and marketing.
But there is a pretty obvious limitation to the Launch Labs piece, right?
Yeah. It relies heavily on theory.
It doesn't give us any hard performance data or real-world ROI case studies proving that this enrichment process actually translates to higher sales.
It makes logical sense, but the concrete proof just isn't in the text.
Still, precision is the only way forward. And taking that exact concept a step further, another source from Dealer eProcess argues that once your data is clean, traditional local TV ads are practically obsolete.
Yeah, this is a fascinating pivot. They say dealers should be moving their budgets to streaming sports.
Like Peacock or Paramount Plus.
Exactly. And the secret sauce isn't just the platform, it's using Amazon advertising data.
Because Amazon knows everything about our shopping history.
Right. They use logged-in profiles and purchase history to target specific households.
So you avoid wasted impressions.
Precisely. The dealer process piece uses a great example. It completely avoids showing a heavy-duty truck ad to a shopper who is only searching for compact electric vehicles.
Which is brilliant. With local TV, you're paying for everyone watching the news, even people who don't drive.
Right. So dealership marketing is shifting away from broad awareness into highly trackable digital ecosystems. But they stress that the ad has to connect seamlessly to the dealership's online retail experience.
Oh, yeah. If they click the ad and the website is broken, the lead is dead.
Exactly.
But again, like the CRM piece, this dealer e-process source leaves a pretty big gap.
The lack of spending benchmarks.
Right. It offers zero independent third-party measurements to prove that these streaming campaigns actually outconvert traditional TV on a dollar-for-dollar basis.
It's a great theory, but we need the math.
So when we synthesize all of this, we're really looking at three major thematic threads across these sources.
Definitely. The first is the bifurcation of the consumer.
Right, which we see clearly in the NDA data showing the income gaps,
Right.
and the Cox report laying out the crushing negative equity for the middle class.
The second theme is targeted affordability. We see that in the California EV source.
Yeah, broad subsidies are dead. It's all about hyper-specific capped incentives now,
And the third theme is precision over volume.
which Launch Labs and Dealer eProcess both support. Dealerships are abandoning mass marketing for laser-targeted data.
But there are massive tensions here, too, contradictions in the market.
Oh, absolutely. Like the tension between 80's optimistic 16 million sales forecast versus the incredibly dire systemic reality of Cox's negative equity warning.
It's a house of cards. The volume is there, but the financial foundation is incredibly fragile.
And there's a huge contradiction in California's EV policy, too.
Right. They want to rapidly expand EV adoption, but they're trying to do it while highly restricting the pool of eligible buyers with those strict price caps and first-time buyer limits.
You want volume, but you're locking the door for most buyers.
Exactly.
So the one practical takeaway from all of this: if dealers want to survive, they have to bridge the gap between their hyper-advanced marketing and the buyer's actual financial reality.
Because finding the perfect buyer with Amazon streaming data is completely useless if they show up to the showroom too upside down in negative equity to actually buy the car.
The algorithms can find the buyer, but the bank still has to approve the math.
And the math is very unforgiving right now.
It really is. Well, thank you so much for tuning in to Auto News Talk.
It's been a great discussion.
In the current auto market, the real challenge isn't just finding someone who wants to buy a car, it's finding someone who can actually afford to.
Spot on.
As we move forward, keep a close eye on whether that 16 million vehicle sales pace can hold its ground as consumer debt and targeted dealer marketing collide. We'll catch you next time.